Kerry Rice is a tech analyst at Needham Co. He joins us now from our San Francisco bureau with more on Groupon. Kerry, welcome back to Bottom Line. Always a pleasure to have you on.
Thanks for having me.
Kerry, questions have been raised about Groupon's financial health. Regulators, specifically the Securities and Exchange Commission, they've questions about the company's accounting methods. And back in August and September, Groupon was compelled by the SEC to amend registration statements. And then at the end of September, the company owed almost twice as much to merchants than it held in cash. First off, why the rush to the IPO, and what does Groupon's financial picture say about its business model?
Well, I think the rush to the IPO is to continue to tap markets for funding. They need financial means to continue to grow and stay ahead of competition. As far as it says about the financial health of the company, I think that the company is going to be one of those that remain after the shakeout. And I think we're starting to see the beginnings of a consolidation and a shakeout in that market. Yeah. And so I think it's important that they have this cash to last through that shakeout. I think it will be one of those survivors in the daily deal space.
Kerry, in its prospectus, Groupon said that it won't need to use proceeds from this IPO for at least a year and doesn't have any urgent cash needs. Because of its competitors, Amazon.com, Google, Living Social, they all offer group discounts, and they're all giving merchants more favorable terms. Groupon, therefore, has had to accept lower margins to avoid losing business. How is that going to affect Groupon's bottom line going forward?
Well, as Corey pointed out, they pulled off marketing expenses and they were able to gain some more leverage in the model. I think they will still need this cash, and I don't know that they necessarily know if they'll need to tap into it a year out or not. I think that it's likely that they will have to tap into it before then, because it is getting a more competitive market, and one of the opportunities for competitors is to come in and offer better economics for merchants, and which would put pressure on margins. So, I think it's important that they do have the cash on hand, because I think it is a very competitive market, and they need all the resources they have available to maintain their market share lead.
Kerry, Groupon's only selling 5.5% of its available shares. That figure is well below tech rivals Google and LinkedIn. Walter Todd, he's with Greenwood Capital, he told Bloomberg, quoting here, "The model of the low float creating its own demand has worked." Is that what we saw today?
Partly. It certainly has created demand. I think the banks have done a good job getting the company on the road. And I think people understand the model. I mean, it is one of the premier tech names right now on everybody's mind. So it certainly has created a certain hype around it going public. And so I think there's a couple of factors that have boosted the stock price today.
Such as?
Well, just the familiarity. 143 million subscribers, so we're all pretty familiar with the company. There hasn't been this big of a tech IPO since Google, and there's a lot of people that are interested in the name, and so I think that, as well as the small float, has helped push the shares higher.